It is Windermere's complete privilege here on Whidbey Island, representing the 4 offices on Whidbey, Langley, Freeland, Coopville, and Oak Harbor, to have the esteemed Matthew Gardner. And I am going to just read off his bio because I forget some of the tidbits, and there's such good stuff that I want to make sure you all know. So Matthew Gardner is not many, I think there's only one other brokerage that has a full-time on staff leading economist with them.
Yeah, well, I think we're still the only traditional brokerage in the country. So some of the other weird ones do, but traditional brokerage, yeah, we're the only one.
And to me, that just speaks to Windermere's commitment to education and really understanding our profession, to being absolute masters at our craft. And Matthew is a huge part of that. He provides so much insight, and we're very lucky to have him focused on Whidbey Island tonight and giving us some real specific insight about our market in relation to the world, really. So as chief economist for Windermere Real Estate, Matthew Gardner is responsible for analyzing and interpreting economic data and its impact on the real estate market on both a local and a national level. This includes publishing the fantastic Gardner Report each quarter, which highlights market conditions in regions throughout the Western US. Inside each region's report, you can find forecasts based on the latest data, including regional home sales, average home price information, days on market, and other indicators to determine whether it's a buyer's or seller's market. Don't need that right now. It is very evident. Links to each regional's report can be found on our Windermere websites and everywhere. And if you would like that emailed directly to you, please reach out to your Windermere broker who invited you to this event, and they'd be happy to send you all of Matthew's reports and links to all of that. With that said, I will turn it over to Matthew. He's got some little tidbits on how to engage, and a reminder, we've got our 32 attendees now and probably more people to dribble in. This is being recorded, and the recording will be provided to everyone afterwards if you want to watch it again. Take it away, Matthew. Thank you.
I will. Thank you, Kristen, for that delightful introduction. And thank you to everyone in attendance today. I know that for many people, myself included, we're suffering from what I define as being Zoom fatigue. We're kind of getting sick and tired of it. And so thank you for taking time out of your schedule, time out of your busy schedules to come and listen to this old English economist kind of wax poetic about the economy and the housing market. Now, for those of you that haven't heard me speak before, I'd like to take a top to bottom approach. So we'll start out with a bigger picture of what's going on in the US economy. Certainly that's very important. What's going on in the US housing market, which is also equally as important. And distill it down to what's going on Island County or in Island County, both from an economic as well as a housing standpoint. I'm not sure, I think Kristen did mention earlier on, I will just repeat it. If you do have a question, please feel free. Type it into the question box you'll see down below. Kristen will be monitoring that. If it's some amazing question, she'll burst in and interrupt me, and we'll get talking about that. If not, at the end, I'm happy to hang around as long as necessary to answer any questions that you may have. So that said, I'm going to hopefully do this. So Kristen, can you just, somebody nod that you can see my screen? I'm assuming you can. Yeah, cool. All right. So let us get going. And starting off, it's a strange world. And certainly from my profession as an economist, it's been fascinating. Fascinating, is that a right word to use? Well, you see, what happened in essence was that in January and February of 2020, life was good. The economy was growing. We were at full employment, adding a couple of 100,000 jobs per month. Incomes were going up. Life was great. And then what happened? Well, this little beast hit. And what did we do? Well, in essence, we turned the economic lights off. And that's something which we never see outside of, quite frankly, wars. And so it's been very, very unique. Now, in terms of what's happening, and certainly we need to just touch for a second or two on new infection rates. These are the national numbers. We certainly saw a third peak. It dropped back down, but here's my concern. Look to the far right. You start to see a modest uptick of new infections, Some parts of the country, not all. And by the way, in Island County, you guys are doing great in that respect. New infection rates are way down. But what we are seeing is that people are starting to feel just a little bit more relaxed about things. And because of that, it's started to notch back up. And that is a concern. Even though some people are now getting the vaccine, it's going to be more broadly distributed. We got through 100,000 injections in 54 days, by the way. So that certainly beat the president's goal of 100 million in 100 days. Is now looking at 200 million in 100 days. I don't think he's going to get there. But the point being is that some areas are feeling a bit lax, and that can have impacts on the economy. I'm hopeful, however, that we're not going to see another massive spike as we go forward, but it's going to be very important to keep an eye on this because it, without a doubt, could impact the economy as we go forward. And as we talk about the economy, a couple of things. One, growth. So this is GDP. It's the value of goods and services we create as a nation. Second quarter of last year, we saw the biggest contraction in in history, quite frankly, in the economy. That unsurprising, I mentioned earlier, we turned the economic lights off. That's what happened. However, in the third quarter, we saw a fairly massive snapback. We saw the biggest expansion in modern history. However, as we go through the course of this year, what you expect to see is that we are going to continue to grow. I don't expect to see a double dip recession, which can happen sometimes where you see a contraction. Recessions, by the way, are defined as 2 negative quarters of growth. I don't see it happening, but we are going to get better as we move through the year. However, this year, right now, I'm expecting 5.8% growth. That is a very, very substantial number. But there are some other people out there, even the Federal Reserve, saying it could get just north of 6%, going to be very, very significant. So my point being is that don't expect to see another contraction. We're going to see solid growth, a lot of it, however, coming in the second half. Why the second half? Well, for a lot of people who have kept their jobs through COVID-19, well, they're making the same amount of money, but they're not spending it in the same way, and money is burning a hole in their pockets. So as and when we feel comfortable going out, what does that mean? Well, we're going to start spending money, quite frankly, a lot of it. And as we do that, that gives a very significant boost to the economy, given the fact that 70% of our economy is consumption, us buying things. So from an employment perspective, the best way I can demonstrate what happened is by showing you this. So from the fall of 2010 until February 2020, we added just more than 22 million jobs. Decent number over the course of a decade. We lost more than that in 2 months. So really quite remarkable. But you do also see a snapback. In May, June, very good numbers, companies kind of reopening again. But then COVID was taking longer to go away. So that rate of growth started to slow. December, we actually went negative. Now, there's a reason for that. Leisure and hospitality, hotels. The hotel sector shed 500,000 jobs in that month. So that made it negative. However, we got through to February, good number there, and the March numbers will come out on Friday. And I'll give you a little advanced warning. I expect a number that's probably going to be somewhere around 600,000 jobs added to the economy. So that's going to be not quite double what we saw in February, but still a very significant increase. And when we think about growth, and I should probably explain this as well. So the number you look here, let's say the 380 number you see on the first quarter. What does that mean? Well, it means that we will have added, hopefully, an average of 380,000 jobs per month for the first quarter. But again, you can see it increasing as we move through the year. As more people get vaccinated, as businesses reopen, certainly in that leisure and hospitality, less so hotels, more bars and restaurants. And we see greater growth in the retail environment. That's going to mean we'll see more jobs coming back into our economy. On the unemployment side, well, here it's, and I expect we'll probably, again on Friday, we'll get the numbers for March. My forecast is 6%. And if I'm accurate, that will mean that for the quarter, we'll come in at 6.2. It is going to continue to trend down as more jobs return. We won't be at full employment until early 2022, and full employment tends to be assumed to be any number below 5%, but it is getting there, and certainly a heck of a lot better than we saw back in April when we were about 14.5%. So what's interesting about this in terms of the economy in general is it's been very uneven. Now, some of you might be aware of the fact that people always like to look at the different shapes of the economic recovery. You can have the classic V, sharp down, sharp back up. You have the U, drop down, hang around in the doldrums for a while, then improve. There were some more interesting ones that came out of COVID-19, though, and one of which was the Nike swoosh-shaped recovery. Very sharp down and a gradual improvement. But what I am seeing, it's a bit different. What I'm seeing is a K-shaped recovery. Why a K? Well, professional services, I'll be honest with you, I don't know anyone that lost their job due to COVID-19. Yes, we are all working at home, but we are all still working. However, more of the face-to-face industries, and the two I will point out are leisure and hospitality, hotels, bars, restaurants, and also retail. And they're still suffering significantly, and they are remarkably important. Why? Well, 1 job in 5 in America is in one of those two sectors. So it is really unequal. But as we look forward, and the shape going forward, well, it's very much this. Housing absolutely has been a super V. It's been the shining light, I would argue, in terms of the economic recovery. Online retail, think Amazon. Yes, I'm sure you, like I myself, I get packages delivered almost a daily basis. Car sales still doing well, but many of the others are in that swoosh shape. Sharp down's going to take some while to come back. Hotels, however, it's going to be a while nationally before we see much in the way of improvement. And another way to look at it is this. If you look at the unemployment rates, these are for February. There are certain sectors, finance, business services, hospitals, remarkably low, absolutely full employment. But at the other end of the spectrum, a lot of other ones aren't. Rental, leasing services, they are hit mainly because of apartments. Food services, we've talked about. Admin and support, well, because so many of us are working from home, our support staff, we don't need them. So they are being hit. Accommodation and naturally entertainment, which is the worst at 17% unemployment. There are some people now who are saying to me on a fairly frequent basis, well, the government's spending all this money, it's printing all this money, and therefore aren't we going to be on the verge of a massive rise in inflation? I would say, no, we're not. Now, this is my forecast for inflation. Yes, are we going to see a spike as we start reopening our economy? Absolutely, we will. So CPI, which is how we calculate inflation. Core, which is you X out food and energy, which is another way to look at it. I think core is one which is going to see a spike, not so much as total, but we're not going to see the kind of 1970s style inflation that a couple of people, and I will point him out, Larry Summers, ex-Treasury Secretary, has been getting a lot of TV time talking about the fact that I expect to see massive inflation. The world's very, very different now than it was back in the 70s. I could talk for an hour about just that one topic. I won't. But we are going to see a bump in inflation, absolutely, but it's not going to go parabolic in the way we saw back under the Nixon administration. So from the big picture forecast, yeah, everyone, all economists certainly are giving a lot of weight to a good distribution of a vaccine, but also, are we going to take it? And we have to assume that most people will. Secondly, a lot of jobs are going to come back, and that's going to keep the unemployment rate elevated a bit longer. Why? Well, if you think about your favorite hotel, well, it's quite likely that when you next go there again, front desk may not be there. Your key will be sent to your phone. And so those front of house staff, limited numbers. Food and beverage services, again, will be limited significantly as well. And because of that, those jobs may well not come back. Those employees, therefore, are going to need to retool, retrain, and get into another industry. And that's going to keep the unemployment rate higher just a bit longer. Big push. I was listening to President Biden today announce his $2 trillion infrastructure program. Every Every president says this, and quite frankly, we haven't seen a major infrastructure program created since President Clinton. Been a long time. Are they going to get it through? Well, I mean, certainly without a doubt, the Republican side of the House is going to push back against it, against the spending. It can be done through reconciliation. So we'll see what happens. But if that does pass, then yeah, we know roads, bridges, they need fixing. Our broadband internet needs to be addressed. If it happens, then that certainly will give a very, very substantial boost to our economy. Ultimately, however, as I say here, yeah, growth this year, absolutely. However, it will be faster in the second half of the year as more people get vaccinated against COVID-19. All right, so the US housing market, and here I'm just going to talk about existing homes. There is nothing to buy. I'm sure you all know that. Nationally, just above 1 million homes on the market. To give you a better idea what that means, the long-term average is about 2.4 million. We're now down at 1 million. It is horrible. Yet at the same time, look at sales. That's the V, or the super V I talked about earlier on. Now, they did see a bit of a drop in February, not surprising. And it's not surprising because of the top chart. We have buyers out there, but there's nothing to buy. So as much as sales have risen significantly from where we saw in 2019, it's still very, very hard for a lot of them. Sale prices, therefore, $313,000 was the median sale price for an existing multifamily and single-family home combined in February. That matches the all-time high we saw back in August. But year over year, it's about 15%. It's a massive, massive jump. Unsustainable, certainly. I'll talk more about that a bit later on. But at the bottom, what's interesting is that price growth we've seen means that almost 1 in 3 homes in America have more than 50% equity. That's quite an extraordinary figure. But I also believe that we are likely across the country to see sales rise significantly this year. My forecast about 6.3 million transactions rather. So you can say, well, Gardner, how can you say that when there's nothing to buy? Well, I believe we're going to start seeing more turnover for several reasons. One of which is naturally COVID-19. And what the impact's going to be nationally is the fact that it will allow people potentially to move out of the more urbanized areas into more suburbs, exurbs, where they can find homes that are significantly cheaper, but they'll put up with a lousy commute if they have to go into their offices a couple of days a week, which, by the way, is what I believe most people will be doing in those office-using sectors. I don't think it's going to be black and white. I think that for a lot of people, 2 or 3 days a week at the office or 2 or 3 days a week at home is the way it's going to be. But it will also be driven by the fact that for a lot of people, then their existing homes aren't set up for working half of a week there. And because of that, they will look to move to find a home which is more conducive to the work from home experience. But finally, the more interesting one, and it'll be interesting to see whether my theory plays out. It's this. What do we do when we look at anything too often? That's right, we get bored. I have sat at my dining room table for 1 year and 2 weeks right now. And yes, I am bored stupid. So I also think a lot of people are going to say, you know what, I really don't like my living room. My kitchen's not big enough. And I think we could see some turnover because of that as well. So in essence, in aggregate, between COVID-19 and just choices, I think that sales will rise this year fairly significantly and be at a level we haven't seen since before the bursting of the housing bubble. There's another reason why I think we'll see an increase as well. That's home price growth. 9% growth last year. Quite remarkable. Second only to 2013, and then homes were still underpriced because we were coming out, as I mentioned earlier, the housing bubble. So massive number there. It's going to pull back down to just shy of 6%. But it's not going to just be a function of affordability, although that is a problem. It is more going to be a function of mortgage rates. So these are the weekly mortgage rates going back to when the pandemic started. And they're fascinating to look at. I include 5/1 ARMs, although ARMs are a very, very small percentage of the market now compared to where they were before the housing bubble burst. But back then, the relative advantage of an adjustable rate mortgage wasn't there anymore. It's kind of quite remarkable. But what I want you to look at is that mainly that 30-year and the 15-year, a big jump we've seen over the last several weeks. What's going on? Well, case counts are plummeting, or they had been, because of COVID-19 and vaccinations. And because the distribution is going well, and it's going remarkably well, and more fiscal stimulus, that could increase the economy. What does that mean? Well, that means that a lot of bond owners are going to move out of bonds and either into equities, or if they believe that we are going to see inflation, they're going to go out longer across the yield, down the yield curve. So they're going to get out of 10-year into 20, maybe 30-year bonds. And what's important about 10-year bonds is that 10-year bonds drive mortgage rates. And literally, they do. Now, we were down below 1% not that long ago. Today, right now, we are at 1.71. So those have risen because of the reasons I've talked about, and that means that mortgage rates are going to rise. So we've seen that spike in mortgage rates, and a fairly significant one, up from 2.8 to 3.1. That's 20 basis points. That's a big jump. But let's keep some perspective. Now, this is where we are now. Yes, the last time we were here back was the middle part of last year, but look at it historically. It is still remarkably cheap. So a lot of people are concerned. However, what does that mean? Well, that likely means that we will see some buyers get off the fence a bit quicker because they want to take advantage of rates that they know are going to rise. They want to get into the market. That's just going to make it, I'm afraid, even more competitive. But as we go forward, my forecast is that we would have averaged about 3% in the first quarter. Again, for the whole quarter, going up, we'll probably end this year, the final quarter of the year, as an average about 3.6. So they are going up, but again, from an historic perspective, still remarkably cheap. Maybe one or two of you bought a house in 1982. And if you did, yep, you know it. Mortgage rates were 20%, well, 18% plus points. So it's a very, very different world now than it was then. But if you don't believe me, I certainly respect that. Every week I have a virtual happy hour with some friends of mine who are the chief economists for a lot of different entities, and we exchange notes on mortgage rates. And these are numbers from our last discussion. Now, Freddie Mac, I mean, they are tending to lag on their forecasts. I believe they're going to raise those forecasts up fairly shortly, and NAR only do their forecast, National Association of Realtors, every 3 or 4 months. So I think they'll do the same thing. But my point being is, in essence, we're all in a pretty tight range when it comes to mortgage rates. So 2021, 353 is my forecast for the yearly average. Mortgage bankers, well, bankers are historically pessimistic. They're a tad higher than myself rather. But ultimately speaking, is that rates are going to rise, but from an historic perspective, still be remarkably low. A lot of people are worried about forbearance. Now, active forbearance plans, it was a program put in by the FHFA back in March. It was a very smart thing to do. But some people are worried, and they believe that what we will see is that when forbearance ends, right now it's scheduled for June, although I believe it's likely going to get extended longer, that people just won't be able to get back on their feet. They're going to end up saying, I can't do this. And we'll see a flood of foreclosures similar to that we saw in 2010, more supply, and that's going to impact the housing market. Don't see it happening. They fell another 19,000 last week. That puts the active number of plans down by about 134,000 over the last month, down 5%. And that's a massive rate of improvement. But more importantly, think about it this way. A full 1/4 of people in forbearance are still making their mortgage payments, even if they don't have to. So because of that, any worries that we're going to see a flood of foreclosures as and when forbearance ends, I think are significantly overstated. The impacts of COVID-19 are very, very significant. And so when this a great unit group put out did a survey a while ago on how COVID-19 is impacting their reasons to move. Well, Personal health and well-being, that makes sense. And if you think about it, a migration away from some of our denser urban areas, absolutely. Where are they? Well, lesser degree here in Seattle, more so in San Francisco, absolutely in Manhattan, and to a somewhat lesser degree in Chicago. So we're seeing it, but it's not applicable to everyone. Moving closer to family, I thought was interesting. I want to stay as far away from my family as possible until we all get vaccinated. But number three, that's the important one, change in work arrangements or employment status. So employment status is, yes, there are some people that are going to have an issue and they're going to move to cheaper markets because maybe they're about renters rather than homeowners. But the choice is the ability to live further away, where it is certainly significantly cheaper. So it's kind of a fascinating way to look at the ongoing impacts. I think they will be ongoing because of COVID-19. So big picture forecast, yeah, rates are going to rise. That could pull some sales forward. We could see more demand, i.e. more buyers coming out there because rates are not going to drop down. At least it's very unlikely. They are going to increase. New construction was helping. We were actually building more homes. That's pulled back over the course of the last several weeks. Why? Well, it's cost related. The price of lumber, construction lumber to build a home is up by 170% year over year. Extraordinary number. And the problem with that is that as costs go up, that needs to be reflected in sale prices. That means that builders are just being a little bit cautious now because they don't want to bring a home in the market that's just unaffordable for anyone to buy. It was helping for a while, temporarily. That, I'm afraid, has changed. And as we see a slowdown in new construction, obviously that puts upward price pressure on existing homes. Move to the burbs absolutely is real. I do expect to see a move out of, let's say, here in Seattle, where I'm based, and people are going to go out either the ex-urban King County markets, but for a lot of them, they're going to go further north. They're going to go north into Snohomish County, south into Pierce County, maybe some, depending on where they work, could come into Island County as well, because of work from home and the relative affordability compared to the prices or the values rather of the homes that they are currently sat in. First-time buyers going to be massive, and they really are. And certainly, as I know that the Biden administration wants to implement a $15,000 first-time buyer tax credit. That's not new. We saw it under Clinton. We saw it under Bush. We also saw it as we were coming out of the bursting housing bubble as well. But this is different. This is money you can use now rather than waiting for your taxes. We know there's a lot of demand. We know there's a lot of urban apartment dwellers who have been told now, you only have to come in a couple of days a week. Well, they're going to move out of their very expensive downtown apartments. They're going to become buyers, and this will boost it even further. So that's nationally. Second half of my conversations is your world. So Island County, well, your labor market obviously is very small. So I'm actually going to include Island and Snohomish because Snohomish's impact on Island County is naturally very significant. So from an employment perspective, this looks at the number of jobs that were lost due to COVID relative to jobs that recovered. And what I found remarkable is the top number. Most jobs lost were naturally leisure and hospitality, but look at the recovery. You're down by only 80 jobs now. It's really quite remarkable. But all sectors, in fact, most sectors other than manufacturing, which is negligible, are doing a lot better. Government, however, is still lower. We know all the reasons for that. So in general, for a majority of sectors, the jobs that were lost, most have come back. But at the same time, you're still down year over year by about 650 jobs. So doing well, even hung in there in March year over year, but then naturally, as we know, the impacts of COVID-19 hit, got better. But we did see a bit of a drop down in February. I think, however, again, as we move forward, that number is going to improve. And from a forecast perspective, yes, you lost jobs last year, but you are going to see some coming back. It's not going to be a massive amount, but we will see net positive growth in 2021. That's a good thing. Unemployment right now about 5.9, a bit higher than I like to see it. There are, however, I would tell you some issues with the reporting because of COVID. I spoke to the chief economist at the state and he acknowledged that was the fact. So 5.9, I think that could get revised lower over time. But again, it's certainly better than the 15.5% unemployment rate that we saw in Island County back in April of last year. In Snohomish County, similar situation. Added jobs, about almost 3,000 jobs came on board in February. Good. They're still, however, down by over 21,000. But when we look at the breakdown, again, it's fascinating to look at. Leisure and hospitality, yes, did get hurt, has got some back, but not as much. But there's a few other things I want you to look at. Mainly look at construction. We've got all the construction jobs lost in the county back and some. Aerospace, talk about that in a second. Very, very negative. Business services down by only 500 jobs. That's a good thing. So in all, it's looking pretty good at this point in the cycle. The cycle being getting companies reopening and also naturally a lot of people getting vaccinated. But about aerospace, so the spikes, the drops you see down here, the V's, well, those were strikes, obviously. We're about 34,800 jobs in aerospace, not just Boeing, but in aerospace in general. That is certainly lower at a level we haven't seen since before 2011. But that said, Boeing is remarkably important. I sit on the Governor's Council of Economic Advisors, and aerospace by far, on a dollar basis, our largest export. But they're not the be-all and end-all that they were from when they were founded, just down the street from me back in 1917 to now. So they were back then, and they were until the early 70s, but we started diversifying at that point in time. They are important, by the way. Diversification was getting into technology. They are important, certainly. However, any concerns that layoffs at Boeing can lead to home price contraction, I just don't see it happening. Most people will find another job. Those that don't, they'll sell. And quite frankly, the Snohomish County market is one that is still very buoyant, as yours is. And so there'll be plenty of demand for those houses. So I do not expect to see a lot of fallout. Jobs will probably add about a bit more than 5,000 jobs in Snohomish County. We lost 20,000 last year, so not getting back to where we were, but it is certainly an improvement. And on the unemployment standpoint, well, 6.2 in February, higher than Island County, but it's a bigger area. Average last year was horrible. I'd like to see around that 3%, 4% number. It is going to trend down, but in all, it's getting better. But it's going to be slow. But ultimately in Snohomish County, without a doubt, aerospace is going to weigh on their economic recovery. So Snohomish County, again, uncertainty. And it's not just Snohomish County, it's your county as well. Boeing is acting as a headwind, and it really is. And again, it's very important for your market as well. Service economy, yeah, you're going to see more people coming in. As they do that, there'll be more demand in the service sector. So I think that's going to bode well as we see more migration moving up, but it's going to take some time to recover the jobs that were lost. All right, so that's the economy, nationally, locally, done about there, talked about the US housing market. Let's talk about your housing market. But before I get into it, I mentioned those younger first-time buyers, and it's these guys, those funky millennials. They are important. And why do I say that? Well, I took a look at the number of homes that were purchased by millennials from June until February, i.e. through that COVID period. And it was fascinating. And it looks like this. Across all the metro areas within the state where I can get the data, significant. Island County, again, 1 in 3 jobs. Now, sorry, 1 in 3 jobs, 1 in 3 sales. But I would just add this. These are people buying homes using conventional, not jumbo financing. So it's certainly not indicative of the entire market, but it does give you a good idea. So you're down around 33%, in essence, the same as the peninsula. Naturally, it's higher in Seattle, and there are many other markets as well that are doing very, very well. So we do find that there are millennial buyers out there, and they are getting older. In fact, we're not going to see a wave of millennials turning 30 until 2022 and 2023, and it's going to be significant. But as far as your world is concerned, well, who were these people? Well, 50% male, 30 female. I know it doesn't make 100, but that is the world in which we live these days. 57% were married, makes sense, double income, no kids yet. And so majority are married. They're a bit older. The average age for a first-time buyer is 31. They're a bit older than that, which I thought was interesting as well. They borrowed about $360,000. They bought a home worth, on average, $442,000. They put 17% down. So they're doing that through either the bank of mum and dad, we all know how that looks, but they're also saving, squirreling money as well. And certainly for those people in the technology sector, stock options are a massive boon for them. They got credit. Average FICO score, 755. That's higher. The average FICO score, by the way, in the Seattle metro area, that's 753. So they got credit. They want to be there. Generally speaking, they're married. And they are a growing component of the island county economy. And it's interesting to see how that plays out as we move forward. All right, so talk about the local housing market. What I've done today is I'm dividing it down into three sections: North, Central, and South Island. I'm not going to talk about Camino Island tonight, but I don't have time. But when you think about Island County as a whole, a few things to look at. One of which is this: you're not moving. The average ownership tenure is about 7 years. That's certainly lower than we see here. It's close to 10 years, actually slightly above that here in King County. Defines some of the more transient nature, but it's still significantly higher than we saw a decade ago. But there's a problem. The problem is affordability. This analysis I prepared at UW since the early 1990s. It's not technically affordable. Now, technically affordable means this. It means that a household making median income can afford a median priced house. For all buyers, not affordable, but it has been affordable for first-time buyers since 2012. It's very hard for them to get that first foot on the rung of the ladder. Are they? Well, of course they are. But the trouble is, it means that tends to be people that are living there, but working elsewhere where incomes are higher. But you have a lot of equity. 39.5% of homeowners in Island County have more than 50% equity. Massive, massive number. So you've got a lot of equity. You see that massive jump that you saw over the last year. Well, that's the reasons that I'm going to talk about in a few moments. Additionally, so interesting to look at population. So looking at this data, roughly just shy of 1,000 children are born in Island County every year. And a bit less than that die every year. So births minus deaths, negligible, 100 people last year. So not much. But what about people moving into your market from somewhere else? Well, add another 611 people. House drop down, it tends to be, you're a very small area there, it tends to kind of fluctuate fairly seriously, but you still have got net in migration of people moving to the island from other parts of the country, or indeed the world. And it's really interesting. So housing has had a bit of a turn down, but it is still positive. What does that mean? Well, that certainly means demand for housing. All right, starting out now with North Whidbey Island. So North, again, a lot of these charts don't do North, Central, and South. They're going to look, obviously going to look similar, but the trend to a degree is going to be the same. There is nothing to buy. 2012, 250 listings. Now, I do adjust my listings for seasonality. Otherwise, it kind of looks like my heartbeat, but horrible in terms of listing inventory. But I want you to look less at that, more to the chart on the right. And I say this because new listings are really kind of explain a lot more. And here's why that happens. You see, listing activity has taken us a number of listings on a particular day in the month. And so that is not really indicative. If a house came on the market at the start of the month and sold and went pending by the end of the month, well, they're not counted under active inventory. So you need to look at it there. Now, you did see a jump there, did pull back in February. So I'm afraid I don't expect to see a big jump in terms of new listings, but it is a tad better than numbers that you will be reading about. Sales by quarter, fourth quarter, massive spike in transactions, which is very level we haven't seen since 2018. So doing well. Over the last 6 years, you've been above the long-term average. My long-term average goes back to 2004, about 500 transactions occur per year. So you're certainly well above that. So you are still seeing, without a doubt, continued demand. But because of a relative lack of supply, look at home prices. I find this is remarkable. If you bought a home back in 2012, well, your home value has more than doubled on average. 12.5%, almost 13%, comparing February 2020 to February 2021. It has pulled back down a bit, again, mainly because of affordability issues, but it's still very, very robust in terms of price growth. Months of inventory in your market, I like to see a number somewhere around 4 is balanced. 4 is not 2 weeks, which is where we are year to date so far. And right now, average days on market is 9. It's really quite amazing. Well down from the numbers you saw in February 2019 or February 2020 before COVID-19 hit. So lack of inventory, a lot of demand, a lot of buyers out there. They're bidding up prices very significantly, as we just talked about. It's really without a doubt, an unbalanced market. So if you look at the different submarkets within the north part of the county, again, it's interesting. So I pulled these. Generally speaking, they were good. There are a couple which did turn negative, Penco, what have you. But again, think about it this way. Most of these markets have so few transactions that you can see massive swings up and down. So I'd like you to ignore the percentage change. Just look more at the absolute number. In essence, there are still some markets that are, relatively speaking, affordable. Mariners Cove not, but again, a very small market. But in general, I think that the market's been performing very well. And if we talk about price growth going forward, 15% last year, my forecast is around just shy of 8% price appreciation, even in the face of rising mortgage rates. So it's still going to do people in the north of the island very, very well. In Central Whidbey, again, nothing to buy. Pull back down in terms of new listings. Well, again, not overly surprising there. Sales, again, up last 6 years, averaged about 124 sales per year. So doing well in the central part of the island. Sale prices have, again, very frenetic again, because it's such a small market, but sale prices, 37%. I don't like comparing one month to another month. I tend to like to look at a blend of year over year growth. So it seems it's pretty frenetic, but it really quite remarkable terms if you think about the average trend in prices over time. Months of a bit more than 2 weeks. It's taking an average of a week for a home to turn pending. And the markets, again, all up, most up in all, about half and half, in double digits, down, rest down in single digits. So it's variable. Still some, relatively speaking, cheap markets out there. That is actually a thing which I'm pleased to see. But price growth, again, I think it's going to be a function of lack of inventory. Prices jumped, skyrocketed last year. The trouble is, though, and I will just caution you with my forecast, I'm comfortable with the model, but in the smaller a market gets, then the more complex that forecast becomes, because a few homes have come on that can skew that dramatically. But I think the bottom line should be this: prices are not going to drop. They are going to continue to rise. Down in the south part of the county, lack of inventory, but new listings actually did rise, which is interesting because we didn't see that in North or Central Island counties. So we are seeing some more listings, but again, they're clearly selling way too quickly. Sales by quarter, very, very significant. I mean, if you think about it, where you were pre-COVID, and look at post-COVID, Q3 and Q4 last year, massive spike. And again, you've been above the long-term average now for over 7 years. That indeed is a significant number. Prices, now we did see a drop down, again, function of lack of homes on the market. So sales price have dropped. 12-month is up by 21%, but again, that compares February 2020 to February 2021. But again, home prices are not tripled, but pretty close to tripling in that period of time. There is about 6 weeks of inventory on the market. Again, not balanced. I do want to see 4, take about 25 days on average to sell in February. Significant drop from that we saw last couple of years. by the nature of it, very competitive. And prices are in general higher, unsurprising, closer into the job centers in the south part of the county. And no big surprise there, that does tend to demonstrate higher prices. And many are up again in very, very significant numbers. So prices have been rising. Affordability is becoming an issue. But as we go forward, my forecast of the south part of the island, about 7.5% price growth is what I would expect to see this year. So in aggregate, what do I think? Well, I want to see more homes. You guys aren't moving enough. Please move. Although I'm not sure where you're going to move to, but a lack of inventory, and I'm afraid I just don't see that increasing this year. There's no reason why that would happen. So it's going to be very, very tight for those people wanting to move into your market. Demand is going to increase. Now, I said that earlier on. We are already seeing a migration north into Snohomish County. Yeah, I would not be surprised to see it come a little bit further north, come into Island County as well. Not so much so in Skagit, by the way. So I think we'll see that occurring. And that means that we're going to see that demand basis is going to be, I think, very robust. Market's going to be tight. There is no doubt about it. But do we look for price growth to slow? And it's going to slow for two reasons. One, affordability. Two, mortgage rates. So they are going to, without a doubt, remain above the long-term average. I have no concerns about that. Your market up there it's a delightful part of the country. I thoroughly enjoy when I come up there to have a chance to speak to you in person, not this year, hopefully next year. And that's a positive. That's not going to go away. So demand's going to be there. And I think demand's going to be solid. Demand's going to exceed supply. Prices, well, they could rise faster than I anticipate, but I'm just not seeing that occurring because of the fact I mentioned about affordability and about mortgage rates rising. But in essence, there's a lot of people that do like the Pacific Northwest. We continue to see a lot of people moving up here from California. One or two are staying in Oregon, the silly ones. The rest are carrying on up north, either into Seattle or indeed up to your neck of the woods. And quite frankly, your home prices, as far as they are concerned, you're cheap. So I think that demand will exceed supply, prices will rise. However, there has to be that ceiling. I think that's going to occur. But in all, when I look at all the numbers, as I do a lot, that is there anything that's scaring me? Quite frankly, it's not. You are in a remarkably beautiful part of the world, and I think that is going to continue. And well, not going to continue. Naturally, it's not going to change. And because of that, there will be a lot of people that would love to live in your area. And with that, I will be delighted to answer any questions that hopefully you have.
Thank you so much, Matthew. I got
Sure.
lots of comments while you were speaking about how great this is and the information. And so we are very, very lucky at Windermere to have you.
Thank
Very,
you.
very much appreciated. I was looking at the calendar and it looks like the last time we were supposed to have you in person in Oak Harbor on March 12th, 2020.
Oh, good
And
Lord.
I think we may have been one of the first places that we had to cancel and make that
Yes, that's right.
decision.
Well, yeah.
And so hopefully, knock on wood, 2022, we will see you in Oak Harbor here in person because there's nothing like an in-person event.
I can't wait.
Excellent. So I do have a couple of
Shoot.
questions. Todd, if you did not get your question answered, please repose it because I lost that one. And then Amy asks, is there any hope for economically for new construction?
Yeah.
And that kind of goes in line with David Day's question about lumber and gas prices increasing and what's causing that. And do you see them coming back down?
Sure. All right. So as I mentioned earlier on, nationally, we saw an increase in terms of new construction for a fairly short period of time. But as I also mentioned, lumber prices, 170% year over year increase in prices. Now, I think we're going to reach a plateau already. If I look at the futures market for lumber, that's already pulling down and suggesting that 12 months from now, lumber prices per board foot are going to be about 18% lower than they are today. There is some hope, but here's the kicker, and it's several. If you are a builder there are not in Island County. Somebody needs to explain that to me. Anyway, in Island County, And you want to build a development or a short plan or whatever it may be, not custom homes. Well, there's four things you think about. Land, one. Labor, two. Materials, three. Regulatory costs, four. Land costs continuing to escalate. We're not going to increase our urban growth boundaries. That's not going to happen. I sit on Governor Inslee's Council of Economic Advisors, and there's no way there's any political will to do that. So that means in some markets that we need to start thinking about our zoning within our areas or our islands, and is it still appropriate? Because we've run out of land, and you certainly have on an island. And so what does that mean? That means we force up land costs. So land costs are very prohibitive. Labor, no one's learning to become a plumber, carpenter, or an electrician. That's pushing up labor costs. No one's going to vocational school. That's expensive. So land's expensive, materials, not just lumber, by the way. Oh, and by the way, we are still putting a tariff on imported lumber from Canada, the Canadian softwood lumber tariff. Hopefully that will get reversed. It was something that occurred under the previous administration. So that would be a good thing. But the issue we've seen with lumber is a couple of things. One, forest fires in California, but also in Oregon and Washington as well. Weyerhaeuser have about 3 million acres in Oregon and Washington, and forest fires were hitting them as well. But more than that, it's supply chain issues. It's getting the lumber out, and that's pushed those prices significantly higher. Finally, regulatory fees, 25 cents of every dollar it costs to build a home. Well, that's fees. That's permit fees, water sewer hookup fees, entitlement fees, all manner of fees. So imagine if you are a builder and you'll put all these costs in and into a bucket, spin it around, it'll spit out a price you have to sell the home for to cover those costs and make a margin. Well, what if that number is $900,000? And what if the market price acceptance point is $400,000? Are you going to build it? No, you won't. So builders are being very cautious, just purely based on the fact of what it costs to build a home. And that's what's holding new construction back nationally, and arguably, I would say the same thing locally. Now, I'm afraid that Island County doesn't report single family building permits other than annually. I've got the 2019 numbers, haven't got the 2021's numbers out yet. But again, I don't expect to see a big jump. And it's just a fact of all the reasons that I've suggested just now. It's very hard for builders. Now, did they build back in 2005? Of course they did. What's the difference? Well, back then it was a thing called OPM, other people's money. And they were great spenders of the bank's money. Well, banks are very cautious now. You can borrow 62, 63% of cost to build a development. So you've got to come up with money on your own. And so because you have to do that, builders are being cautious. I would love to see more development, more houses built. We've got a growing population, although population growth has slowed. That could pick back up again, depending on how the current administration plays that game. But the issue there is affordability, because we're not building more. We have got all these millennials. Where can they afford to buy a home? 69% of all millennials believe that buying a home will be the most astute financial investment they will ever make. They want to. They're getting older. But affordability is a big, big constraint. Hopefully that answered your question.
That was fantastic.
Cool.
We have one more question about vacation rental market. But before we do that, I just want a little infomercial for our brokers on here. So Windermere on Whidbey Island puts out this great annual report every year with lots of data that's about the island. And we also are getting Matthew's videos. Are you still doing those?
Yeah,
Not weekly now?
not every week now, every month. So yeah.
So if you want to watch Matthew's videos on different topics, if you want his beautiful quarterly report, if you want our local reports, please contact your Windermere broker and get on their email lists, get on their mailing list, and they put those products out to their clients regularly. The last question about vacation rentals is we have a large vacation rental market here that feels like it's growing, but is there any data or info that we might need to know regarding that? I know that Island County doesn't collect data on that yet. Regulators are slow, but we are seeing signs that they're starting to clinch down and talk about how they can collect data and what they're going to do with that data. It should probably be a long time until anything's done.
I can imagine.
But what are you seeing maybe from other markets that might be a warning for us?
Sure. Well, just going back to what you just said, my March video dropped, I think, on Monday. So please, if you have an interest on listening to me even more, feel free to go and find it on YouTube or via your broker. So for a brief period of time in March and April last year, actually April, probably through May and June, big concerns, big worries about Airbnb, VRBO, et cetera, et cetera. And there were worries. And there were worries that markets disappeared. However, the snapback that we saw there, very similar to that we saw in the ownership market as well. I think there's a lot more people now who are just being very cautious about the fact that, do I really want to go to, let's say, the Marriott in San Diego in a 1,000-room hotel? Or do I want to go into a house where I think it's going to be safer for me? And clearly, a lot of people have been thinking that way because demand for vacation rentals has been very, very significant. And the boost that we've seen has been very dramatic. So is it going to go away? No, it's not. And in fact, I think the future is potentially very positive in that respect, because the fact that a lot of people who certainly we all want to go away, we all want to travel again, we want to stay somewhere other than our homes. But a lot of people are now saying that it could be safer, at least for the time being, going into a VRBO, a vacation rental home, as opposed to a traditional hotel. And we're also seeing a lot of people buying second homes as well as a permanent alternative to hotel-based vacations. Now, an example I will give you, I was speaking to our owners of our offices in Montana, and they told me over the last 6 months, they've seen more demand for people looking to buy vacation homes coming out of Los Angeles and out of Manhattan than they've ever seen before. Really quite extraordinary. Although I will tell you this, I want to see a Los Angelian survive a Bozeman winter. We'll see if that works or not. But the point being is that those are occurring, and people are buying, again, as an alternative to traditional hotels. And as far as those vacation rentals, well, I think that market certainly already is outperforming hotels. Our hotel vacancy rate last week here in downtown Seattle was about 20%, or occupancy rate rather, was 20%. That's just woefully inadequate. So it's very hard here. I think for hotels, both business travel and pleasure travel is going to be an issue until probably 2023, but that can be a benefit to people who do own those vacation rental homes. So yeah, I think the future for vacation rentals, as far as if you own those units, I don't see a negative. I think it's been nothing but positive. So that's an arena that I think is going to be one of the, is going to benefit from potentially COVID-19. And certainly if you look at the publicly traded companies involved in that space, their shares are doing great. So there's a lot of demand, and that I think it could be a market which is going to outperform as we go forward.
And if that didn't answer your question, Amy, let me know. But actually, we are out of time.
Oh, no, we are. Oh, no.
Oh, well, I don't want to keep you.
Oh, no, I'm fine. I will happily answer questions as long as anyone else has one. So ask me about anything. I don't care.
Oh, anything about the economy or anything. Are we
anything about anything? Yeah. I'm an economist. I'm good at making stuff up.
Matthew, you did. I think it was nice for you to share the little story of, obviously your accent is not from here, but
Correct.
give us just a little bit of a background about how you got to the States.
Oh, wow. So wow. Okay, I'll give a 2-minute elevator speech. So I was very grateful. I was offered a seat at Oxford University to take my undergrad in economics. And so my mother back then said, like, what the hell are you going to do with an economics degree? Mum, every decision you make, I can find an economic principle behind it. Therefore, I should always have a job. To which she said, crack on, all yours. But she didn't think that I'd get too into to academia. So after I got my undergrad, I went up back to London to London School of Economics. So I got my master's, my doctorate. So it's I kind of stayed in school. She thought 3 years and ended up being 11. But the point being is that when I graduated, I ended up working for the company that managed the estates of my old college back in Oxford, a company called Clutton's. And so they managed portfolios of land and of houses and all manner of stuff. And that was great. So I enjoyed going back to Oxford and working there. But one of their other clients was the royal family. And that brought me across to America because back in 1776, you didn't get it all back. We kept rather large bits of the East Coast. So I spent a lot of time in Boston, New York, looking at, put it this way, if you've been in Manhattan, I can almost guarantee you've walked on Crown property. It's my only lifelong NDA that I have. They'll put my eldest child in the Tower of London if I ever talk about it. But so that brought me, so I was coming across to the US fairly frequently. My sister had already moved here. She married an American working for Microsoft. I came across to Seattle to visit with her. And I remember walking through downtown Seattle. It was really interesting, mid-afternoon downtown. And it's busy, things going on. Stopped in at the library bar opposite what was the Warshaw Sporting Goods site down on First Avenue to have a couple of cocktails. I walked out at 6:30. I could have fired a bazooka down First Avenue and not hit anyone. I was like, did Clinton just, there a war? What's going on? So I'm a nosy economist. So I ran off to the library and did some snooping. And what it told me is that everyone lived in Seattle, everyone worked in Seattle, but no one lived here. They left at 5 o'clock, went across a bridge that had sunk the year before and lived in a place called Bellevue. And so I said, well, who tells these developers what they should and should not build? And I found out very quickly, no one did. And I mean, literally no one did. And so I said, okay, well, I came here back, it would be 1996, and hung my shingle out and went to every development company and every broker and said, well, what if I could tell you or your clients what you should build and what the demand's going to be and what the price is going to be, blah, blah, blah. And that was the start of it. And I met the Jacoby family in 1997. And I became the consulting economist for Windermere in 2000. And I was that way until 2015 when they taught me into coming on board full time. So that's the elevator story on how I ended up here. And my interest in real estate and housing is, well, housing is an organic good. We've always needed shelter. We will always need it. And so I think it's remarkable to try and gauge what's really going on. And I've got 6,800 brokers out there within the Windermere footprint. And my job is to make them the smartest ones there are out there.
Yes, and you do a darn good job of it. Thank you.
You're too kind.
We did actually have 2 questions come in that might be interesting. So one of them, thank you, Amy, is you shared that about the county government job loss, but it's confusing as to why there was COVID affecting government jobs. I don't remember that slide. But...
that's it. And there is no breakdown, although I could probably find it. In terms of what's really going on. So I'm going to kind of Twitter and look at the numbers at the same time. So what is interesting about government employment, the big bump, quite frankly, was because of one reason. What happened last year? Yeah, census. So there were census takers that got hired and then they got fired. And that, for the better part, is the reason behind it. So it's that's the one thing that springs to mind, that it more than likely is the reason for it. I'm not sure if that answers your question or not, but a lot of it is because of census.
That's great. And then the other question from Heidi is the condo market softening here? Do you see anything about that, like it is in Seattle? And maybe tell us a little bit about the condo market softening in Seattle.
Right. I don't talk about the condo market in your world because really you don't have one. It's de minimis. So it would be, given the fact I've only had 45 minutes to talk, that makes sense. So 2 things. Urban, yeah, in downtown Seattle, absolutely. And I think there's a combination of reasons for that. First one is naturally the old adage of I want to live downtown and live next to 400 of my best friends. That's gone away. If you think about, why do you buy a condo downtown? 2 reasons. 1, proximity to work. But if you're working from home, you don't need that. 2, lifestyle. Lifestyle is important because you want to enjoy the bars and the restaurants and the civic amenities. Well, most of them are shut down. In fact, I was speaking to a dear friend of mine, Tom Douglas, and Tom owned about 13 restaurants in Seattle. He shut them all down, bar one. He may well open maybe 1 or 2, but that's it. So a lot of the raison d'etre, so the reason to be at downtown has gone away. And on top of that, here in Seattle, we have a massive homeless issue. City council is certainly, it's very, I won't get political, but it's there are a lot of issues here that we have here downtown. So does that mean that, are we seeing a great number of people looking to move away? Sure. However, that said, those people are selling, and so listing inventory has risen, but so have sales. So we are still seeing that backfilling. So much people that want to leave, there are still people coming in. Now, looking further north, it's a bit of a different story. Again, your market is remarkably small in that respect. And I think that it's people can live in small, but I think you look at the maybe duplexes, triplexes more so than stacked flats. That will there be demand if it is allowed? I'm not sure what zoning is on Island County to demonstrate what I'm trying to say, which is that can you build them? If you can, then I think there would be demand, but more for low rise. So 5/1, I would argue, be the highest you'll likely see, depending on how zoning works there. I mean, maybe zoning on Island County is the same as it is on Maui. Kauai. You cannot build a housing development any taller than the tallest palm tree on the island. Little known fact, but it's true. So I think that it's going to be interesting to see how that plays out over time. But I think the issues are urban markets, urban areas. Quite frankly, only one, Seattle. We're seeing far less impact in Bellevue. Yes, it is. COVID-19 is impacting it. However, ex-urban, certainly far, far less. So it's not that much of an issue.
So you're saying that in Kauai, there's a bunch of condo developers out there with fertilizer around all the tall.
You better believe they are.
I bet, yeah. Okay, there's 2 more questions, and then I'm going to cut it off because we're losing participants as we speak.
That's okay.
But this is great. A question about kind of the deurbanization forecasted to continue after COVID or resurge, and then a question from Elgin about infrastructure funds. If they became available, where do you think they would be best spent?
So the first one is,
deurbanization continuing after COVID?
Right, okay. All right, so that one first. Yes. Yes, I mean, I think that the resurgence of the suburbs and areas further out. So here's the way I want you to think about it. Historically, house prices tend to reflect your proximity to your job centers, right? So the closer you get to the job center, the more expensive housing becomes. And certainly here, because there is a value to our time, we will pay more to live closer to where we need to be. That's fairly logical. That's the reason why home prices here escalate far more than in, let's say, Houston, Texas. Well, Houston has a traffic jam. What do? They build another ring road around it and call it good. So there are significantly fewer issues there and significantly more land. We don't have that. However, work from home, yeah, it is real, as I talked about earlier on. And we're also seeing the fact that a majority of people that have the ability to work from home are what? They are home owners and not renters. So the more that continues, and I think that work from home is real. We tried it back in the early 90s. It failed then. I don't think it's going to fail this time around. It's going to be tangible. And that means that we are going to see more and more interest in those ex-urban and suburban markets, whether it be within the county here in King County or going out to Snohomish, Island, Pierce, and Kitsap County as well. So I think there's going to be, this is not a short-term thing. This is going to be demand that is going to continue over time. So I don't see this as being a temporary situation. Now, ultimately, yeah, one thing I learned about Americans, you're not much attention span, but you tend to forget things pretty quickly. And we like to forget about the bad and think about the good. But this time around, I really think it's going to have legs. And so I really do see the resurgence of the suburbs as being something which is not going to go away. It is going to continue. Now, what was the second one?
Right. The second one is, and I can't wait to hear what you have to say about this because it's an opinion piece, very much. If infrastructure funds became available, loads of them, where do you think they would be best spent?
Oh, wow. Well, I mean, certainly roads and bridges. I mean, you guys know it where you are. So obviously, Skagit County, we know what happened there a couple of years ago. Bridges are falling down. Roads are in massive state of disrepair. That's the low-hanging fruit. That's the easiest thing to do. We need to move materials across our country. Most go by road or rail. So that's going to be an important thing. So that's why I expect the first part to occur. Second part, probably it's going to be, I would argue, growing broadband internet access across the country. That is something which I think that we are very lucky here, as we all know. A lot of parts of the country, I mean, they're not on dial-up, but it's not good. So I think those are the two things that I expect to see the most money spent on. I was giving a speech down in Portland. I wasn't there, I was here, but to a group in Portland. A big issue with Clark County in Washington is the bridge, I-5 bridge. It's going to fall down. There's a problem with that. It needs to be replaced. But where's the money going to come from to do it? So roads and bridges, I would say number one. Internet access, broadband internet would be number two. And that's certainly, given what I listened to from the president in his speech today, those are two things I think he plans on spending or trying to spend the most money on. But again, the big question is, will it happen? Try and get it through Congress. That's going to be hard. We know that one side of the aisle will be supportive, the other won't. It can be done through resolution, so it can occur, but it's going to be a big push to get it done. And we know that several presidents have tried to implement that before. But as I mentioned in my comments, the last one that actually got it going, well, that was President Clinton. And by the way, President Clinton back then, when that happened, we saw the longest term of economic expansion in a very, very long time. So it does work. That's what I would expect. Most of the money, if it can happen, $2 trillion. It's a lot of cash, but that's where I think the focus is going to go.
Thank you, Matthew.
Sure.
All right. So thank you so much, everyone, for participating. Matthew is very accessible and your brokers have lots of information from him. So if you think of something later on, or if you get the recording and it brings up other questions, definitely reach out to him. Have a great rest of your day.
Before everyone leaves, what I will tell you is that I will be sending the slides to Kristen from tonight's event. You have those tonight or tomorrow. So reach out to your brokers. They will have access to them. Feel free to ponder them at your leisure. It's great bedtime reading. It'll send you to sleep in a heartbeat. So enjoy them. I hope you got interest or something out of my comments. If you do have any questions, if you're a client for Windermere Broker, ask them. They know how to find me. I don't go anywhere. And I would be delighted to address those as and when they come up. But thank you all for your time and stay safe.
We'll leave with Michael's comment, best economic discussion he's had in years. Thank you.
Too kind. All right, guys, be safe. Take care.
Bye, everyone. Thank you for joining.